Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. It is the last trading day of the week, and right now, just an hour to go until the closing bell. And stocks, we're mixed here. Look at the popular averages. The Dow's up about 110 points. Your S&P 500, your broad gauge, that's down about 0.1%. And meanwhile, your tech-heavy NASDAQ, that's down about 0.4%. Let's welcome in here. We have Spear Investment founder and Chief Investment Officer Ivana Delevska and Data and Markets Editor Jared Blickery joining us to help break down all the headlines. Jared, kicking it off with you, my friend, for more on today's trading action.
Yes, we started in the green with the Dow, and we are staying in the green. I'll show you an intraday chart, but we have definitely lost some steam, trying to regain it a little bit in the afternoon session. And here's the NASDAQ, never touched green today. You can see it's only down by about 1/3 or 0.4% there. And the S&P 500 down a whopping 18 basis points, nothing to write home about. And we'll also check in on the small caps. Russell 2000 down 0.4% as well, although it's up about 3% for the week, so it has had a good showing. And let's get to the 10-year T-note yield. It's up a couple basis points, or 3 basis points, to 4.33%. The 30-year T-bond yield, 4.92%. And the U.S. dollar index going in the opposite direction. It is down about 0.4% today. And let's check out the sector action. We have healthcare. That is the leading sector for the week, I believe, and the month of August. It's up almost 2% today. Usually defensive in nature, but in August it's leading. Real estate second, then communication services, staples, energy, materials rounds out the top row. What is not working today, financials and tech, both of those down about 0.8%. Also consumers, discretionary, and industrials. So the cyclical trade just not working as well today as it has in previous days this week. And you can see a mixed board in the NASDAQ 100, Alphabet up over 1%, but for the most part, we're not seeing outsized gains. If anything, we're seeing some losses in the bigger stocks here, the mega caps. Nvidia down 1%, and then Broadcom and Tesla here, both of those down about 2%. And I'll take us to the Dow as well, where we can see, excluding some of the big caps that we just saw, kind of a mixed board. I'll call that a mixed board here. Procter & Gamble up 1%, Cisco down about 5%, Merck up 2%. Again, those healthcare stocks really outperforming this month. And I wanted to show you some of our leaders here. In the upper left-hand corner, you don't see this too often, but TAN, that is a solar ETF. That is up 10% today. That is one of the leaders this month too. We just got some favorable information, less bad than feared about, I guess, subsidies in that industry. Then that comes from the President Trump administration. And then KWEB, that's a Chinese tech ETF. That's up over 1%. Biotech is doing well. Software is the worst performing sector or industry of the month, but it's doing well today. And then what's not working today, cannabis. Cannabis got a really nice pop over the past couple of weeks on some other news in the Trump administration, lowering the schedule threshold for cannabis. And then chip stocks. We should go to chip stocks as a heat map and just show you a lot of the outsized losses that we're seeing here. Applied Materials down 13% off of some negative guidance that they provided. Lam Research down 7%, KLA down 8%, and not as bad in software. In fact, we're seeing a lot more green than red. So software has not been doing well this month, but it is doing better today. Salesforce, which has been beaten down recently, up about 4%. And I'll send it back to you on that note.
All right, thank you, Jared. Well, President Trump and his Russian counterpart are meeting in Alaska Friday. The talks carry high economic and geopolitical stakes that could ripple across commodities and global markets. Doug Redeker focuses on global economy and development as a non-resident senior fellow at the Brookings Institution. Doug, it is good to see you here. You know, it's interesting, Doug. So the White House is calling this a listening session, Doug. So sort of sounds like they're tempering expectations. But what are you watching for here, Doug? What are you listening for?
Well, first of all, the most important thing that's happened in the last half hour or so is that the one-on-one meeting between Putin and Trump has now been shifted apparently to a 3-on-3 meeting. I think that's an extremely important signal, assuming that's the way it plays out, because a lot of people were worried that Putin and Trump one-on-one could say or agree to things where Putin is, considered to be the better, more clever negotiator on a bunch of different issues that, let's just say, Trump might think that he knows what he's up against, but that Putin probably would have had the better of him. So the 3-on-3 is actually an extremely important development. And I think that does portend well for the outcome if you're a Ukraine watcher. because the alternative might have been that Trump gave something away without realizing that he gave it away. That's my initial takeaway. By the way, I'm looking at your shot here. I think it's funny to think that Putin's on one plane, Trump's on the other, and neither one wants to be the alpha dog who lets the other one get off first. So I think that's what you're watching as a dynamic we're going to see unfold as the day progresses.
All right, well, somebody has to, Doug. We got to get this thing going. Let me ask you this. The fact, Doug, that for the Americans, it's Trump, but it's also Besson, it's Lutnick, so it's Treasury and Commerce. What does that potentially signal to you?
Yeah, I'm really worried about this because I actually think that the more that this meeting, assuming it happens and they both get off their planes, the more that this meeting takes into account the broader commercial relationships between the U.S. and Russia, the worse off that is for Ukraine. Because I think that Trump and to some degree Witkoff and Lutnick and others are more focused on the broader commercial relationship between the U.S. and Russia longer term, whether that is the Arctic or energy or other trade relations. The more they get into that, the less likely it is that what I would consider to be the Russian aggression that has been egregious as an impediment to getting relations between the U.S. and Russia back on track, that it is more likely that those commercial things sort of take a dominant role in the relationship and Ukraine ends up paying the price. So the more we see Besant, or in particular Lutnick, playing a key role here, the worse off it is for Ukraine. That's why the 3-on-3, as it's apparently being structured so far, is going to be Trump, Witkoff, and Rubio. And while Witkoff is more in that commercial camp, Rubio is a long-standing, relatively sophisticated, experienced Russia hawk. So I think that makes a lot of people feel a little bit better that maybe the Ukraine card won't be compromised for the sake of commercial opportunities that will actually never be seen.
But let me just ask you, Doug, is there an economic deal that the Americans could potentially put on the table, Doug, in your opinion, that could motivate Putin to say, you know what, that's a deal I'll take, that would encourage him, motivate him to make a deal that with the Ukrainians would find satisfactory?
Absolutely not. In fact, I mean, if anything, the risk is on the other side, that Putin tempts Trump and those around him with promises of riches and the opportunity to co-invest in the Arctic and create new forms of energy that the Americans and the Russians could do together, and that Trump might actually feel prone to accepting that. I think it's a misunderstanding of what Vladimir Putin is about to think that he cares about wealth. Putin cares about power and his legacy. And so the idea that there's a commercial opportunity the U.S. could put on the table that would tempt Putin to disavow his aspirations for Ukraine is a non-starter as far as I'm concerned.
Doug, we could see President Trump walking down. They're exiting the plane now. Now we wait for Putin, of course. Let me ask you, Doug, let's say this goes south and Trump is not happy. He comes out of this, he's disappointed, he's frustrated. Then what are some possible scenarios, Doug? Could you see Trump applying more pressure to the Russians?
Well, you heard Trump this past week say, well, I could dramatically escalate pressure or sanctions against Russia. I think that's an almost zero possibility. First of all, because whenever anybody talks about tariffs being imposed on Russia from the U.S., let's remember, we have almost no trade with Russia as it is. And the areas that we do have trade with Russia are the ones that we benefit from more than they do. So, for example, fertilizers, there's some uranium processing, there's some other issues that we can only do with Russia as our partner that the Biden administration and the Trump administration have said, well, we're going to exempt that from tariffs. But other than that, basically, we don't trade with Russia. So the idea that Trump is going to impose sanctions or tariffs on Russia is kind of meaningless, except in the context of what he did this past week, which was to put tariffs on India as a means by which to punish Russia, which, to be polite about it, is ridiculous. If you really want to go the secondary sanctions or secondary tariffs route, then you go after China, which is the biggest trading partner for Russia and the biggest purchaser of Russian energy supplies. But Trump feels that he's got too much at stake with the U.S. and China, so he's taking it out on India.
But let me ask you, Doug, and you know this issue a lot better, obviously, but my understanding is the Europeans do have pretty significant sanctions on Russia. So how does he have the money, Doug, to fight this war? I mean, is it mostly from China buying his oil and India buying his oil?
I mean, Russia has always been extremely dependent on the exports of oil and gas, and so that's where they get the bulk of their income. And that has been reduced, but it's certainly not gone away. And a lot of that does come from China, from India, from Turkey. There are a number of other buyers around the world, but those are the big ones. And again, as I say, if you want to pick on India, well, if you pick on India but you don't pick on the others, then Russia's simply going to divert its oil from India to China, and then some of the other supplies that China's been benefiting from will simply go to India. So while oil is not purely fungible, it's not as if you can just turn off India and make Putin pay a price. Russia's economy is right now a very wartime economy. They are benefiting from trade with China, exports to a variety of countries I just mentioned of their oil and gas, and they're overall suffering from a stature loss and a trading partner loss everywhere else in the world. But as long as the war continues, they're surviving not just fine, but they're surviving.
And Doug, we see Trump and Putin now. They've both exited, shaken hands. Let me ask you, we've talked about Trump. Let's talk about Putin, Doug. What does he consider a win out of this?
I think he just got a win. He stepped off a plane on American soil for a summit with the U.S. president. They're smiling. I'm looking at it, in the screen and behind you. I think Putin just won. So he could leave right now.
Are you saying, Doug, are you saying he won simply by virtue that he's there, cameras rolling, next to the President of the United States, he looks like a player, he doesn't look isolated?
Absolutely. Yeah. And he had to give up absolutely nothing in order to get that. Traditionally, diplomacy works where one side has to give something to get something. And in this case, Putin gave nothing. I mean, the origin of this summit, as far as everybody can tell, is a misunderstanding by Steve Witkoff of what Putin was offering. And Witkoff came back to Washington, told Trump, and said, oh my God, there's actually a deal to be had here. And then it was only after they'd agreed to the summit that they clarified, and the deal they thought was on the table was not the deal that's on the table. So Putin showing up, he's this is a guy who, remember, has been indicted by the International Criminal Court as a war criminal. He can't show up on most countries on the face of the earth without violating that International Criminal Court order. But he's now in Alaska on American territory, shaking hands and smiling with the President of the United States. That's a win.
How would we know, Doug? What would be the signals that actually this was successful, this was meaningful, something material came out of this? I mean, should we actually be just watching the length of time here, Doug? I mean, if Trump and Putin are out of this meeting in an hour, is that a signal things didn't go well versus, hey, if 5-6 hours later from now they're still talking, it's maybe something actually productive is coming out of this?
I would not mistake longevity for progress. I think the original schedule is that President Trump is supposed to be wheels up out of Alaska at 5:45 p.m. Eastern time, so that's basically in 2.5 hours. If it goes longer than that, I think there's still supposed to be a press conference scheduled. That promises to be must-watch TV, given what we saw in Helsinki in 2018. So I think the signals will be if, obviously, Trump and his team leave early. If they stay late, I'm still not taking that as a sign of progress, though clearly that's a different signal than if he leaves early. But again, I'm very nervous that they're going to get into a broader range of issues well beyond Ukraine. That's what makes me nervous, because then the definition of success starts to become talk about joint investment projects in the Arctic and that sort of thing. And the more they get into that, the worse it is for Ukraine. And let's remember that Putin's goal, not only in showing up and being greeted as a world leader, but Putin's goal is to drive a wedge between the U.S. and the Europeans and the Ukrainians. And that will be a real must-watch thing in the press conference, how much space there is between the U.S. and the positions that were agreed with the Europeans and the Ukrainians earlier this week. That's what Putin wants, and that's what a lot of us are worried that Trump is going to potentially give.
Doug, great to see you and great to have you on the show today. Appreciate all your time and insight there.
My pleasure.
Well, Intel shares rising as the Trump administration considers taking a stake in the U.S. chip maker. That's according to Bloomberg report. For more, we're bringing in here Yahoo Finance tech editor Dan Howley. Dan, it is great to see you. So on this report, Dan, we got a headline, we got the report. We're light on details, but what do we make of it so far, Dan? What do you think it could mean potentially for the chip maker?
It could mean a number of things. Some kind of cash infusion. Obviously, they need that. In particular, I was just speaking to Patrick Moorhead, analyst, and he basically had said they need about $40 billion to kind of, just ensure that they're even keeled at this point. They are a company that, we've talked about this many times, is struggling with their foundry business, nowhere near NVIDIA or AMD when it comes to AI. And so they're kind of flailing at this point. CEO Lipton made some big decisions, decided to cut back on some of his plans, the company's plans for plants in Europe. They delayed the Ohio plant more. But they're still ceding ground in the client space, the laptop desktop space to AMD. They have an up and coming challenger in Qualcomm. The server space is also something that they need to ensure that they're able to hold on to when it comes to AMD. Qualcomm would love to get in there as well, and ARM chips work there. We've seen NVIDIA pull it off. So it seems as though they just need a win in one direction or the other, and this could benefit them. On the flip side, we have to then see what does that mean for other chip companies that operate in the U.S. TSMC is building plants here. Samsung building plants here. What does that mean for them? AMD is a U.S. company. What does that mean for them, right? If the government seems to pick a winner here out of all of these companies. Again, it's Intel, so they're of strategic importance. But I think there's still a lot of questions as to what this means overall for Intel and the chip industry at large.
Do you think, Dan, if it happens, and we have to see, is this a unique one and done, or do you think, no, this could be a model for others?
I think it could just be a unique one and done, just because of, like I said, the strategic importance of Intel. They make the most advanced chips in the U.S. That's U.S. based. It's the most advanced producer of chips from the U.S. And so they're incredibly important, right? There's this fear, and the reshoring obviously is part of this goal of ensuring that the U.S. is able to have its own stable flow of chips. Intel is a key aspect of that, right? If TSMC gets cut off because of Taiwan, if Samsung for some reason is unable to provide chips here, where are the most advanced chips coming from as far as manufacturing? Intel. And so the idea of having this, the chips have been spoken of as being as important as oil now was in World War II. It's critically important for this to remain in the U.S. and thrive. And so I think that's where Washington stepping in kind of makes sense to a degree. And, we've seen it with the CHIPS Act, right? Intel won the bulk not the bulk, but the largest share of money from the CHIPS Act to allow it to build out. And, Pat Gelsinger, his idea to turn into a third-party foundry doesn't seem to be bearing fruit as much as he had hoped or Intel had hoped. Lipton still going forward with that plan. We just have to see when it starts to come to fruition in a good way. Right now, Microsoft and Amazon have contracts to get chips from Intel, but Intel's still the foundry's largest customer. Its own largest customer is itself.
All right, we wait and we'll see what happens. Dan, thank you, my friend. Enjoy the weekend. We are just getting started on Market Domination. Coming right up, Warren Buffett's Berkshire Hathaway has United Healthcare in its sights. I'm going to explain why. Plus, Salesforce being seen with fresh eyes by investors thanks to an important upgrade. And an interview you don't want to miss. We're speaking with a potential candidate who could be in the running to be the next Fed president. Stay with us. Those stories coming up. Stocks mixed ahead of the close, but on track for a big weekly gain here. My next guest sees the S&P 500 heading to 6,500 to 6,700 by year end. It's a maximum gain of 3% with a bull case for 8% growth. But in the short term, for August and September, he's seeing a little chop. Joining me now is Ahmed Riesgo, Insigneo Chief Investment Officer. Ahmed, it is great to see you, sir, as always. So you say here investors should prepare for a short-term chop. How do we define chop exactly, Ahmed? What do we mean by that, and why? Why is that coming?
Look, this is historically a very weak seasonal period, right? The months of August, September, even into the beginning of October in a calendar period tend to be the weaker months out of the year. So given the fact that we've had such a strong rebound from that April 8th low, it would not surprise us at all to get some type of pullback, some type of convergence even in the markets. It doesn't have to be a sharp pullback, but some sort of consolidation to set the next leg up of the trade.
All right, so near-term consolidation, but long-term you're constructive still, Ahmed. Walk me through the reasons why.
I mean, for many, many reasons, but really the bulk one or the main one is we really see the diffusion of AI technology just really in its infancy, right? We think we're sort of in the middle of phase 2. We think phase 3, 4, and 5 are still to come. I think if there's a contrarian view here, it's that we're actually about to unleash a deflationary wave across the world over the next, 5 to 10 years.
Let me ask you, what would be on your wall of worry, Ahmed, though? What are the risks we need to think about? Is it valuation, sentiment, positioning?
Yeah. So right now it's all about the Fed. In our opinion, the Fed should probably have started cutting rates back in June, but at the very least in July. You have to remember, as inflation has been coming down for over a year, the real rates have been going up, right? So there's been a stealth tightening going on in the economy. The labor market is starting to show strains, especially with much, much weaker demand, right? We're in a low firing, but also low hiring environment. And so the Fed could sort of preempt it by cutting rates. We think they should have started in June. Remember, this is sort of like if you start to slow down the car, once you're in the turn, you're gonna veer yourself off. So you need to start slowing down before you hit that turn. The Fed should be anticipating this. They should have already been cutting. So that's, I think, the biggest risk to our bull thesis.
So you agree with President Trump, it sounds like, Ahmed, that it's too late, Powell. He's late. He should have been cutting. Do you agree with Trump in terms of how much they should have been cutting?
So we agree with Trump directionally. We think he's right. However, we think he's going about this completely the wrong way. In fact, I think his public pressure campaign on Powell is actually working against him because we think it makes it less likely that Powell actually cut rates because he wants to lean against that and sort of lean into the Fed's independence. So in a weird way, Trump is actually sort of campaigning against himself. Now, why do I think he's doing it? Well, I think he's doing it because it sets up a perfect scapegoat if the economy does fall into a recession and the labor market starts to deteriorate. He can say, you see, Powell, I've been telling you that you should have been cutting rates. It's an easy fall, guy.
What are the risks, though, Ahmed, to cutting when your inflation target is still above where Jay Powell wants it to be?
Yeah, so it's go to where the puck is going to, not where it is today. The disinflationary trend is quite strong. The only reason why we're seeing this pick up in inflation is because of the tariffs. Now, historically, this would not be much of a debate at all. Central banks would tend to completely look through tariffs as a temporary increase in price, just like they would an oil shock. Obviously, there's a lot of politics involved in here. And so we think that this is what's leading to a potential policy mistake from the Fed.
Now, we don't have to wait till September, of course, Ahmed. You're going to hear from the man himself, Jay Powell, next week. Jackson Hole. What are you listing for? What do you expect him to say, Ahmed? Do you think he signals that, yes, that cut is coming in September?
Look, I think he will. Right now, Fed funds futures are sort of pricing in close to a 90% chance that the Fed cuts in September, which again, we think is the right call. I think if Powell were not going to do that, remember, they don't want to surprise markets at that September meeting. So I think he's going to be mentioning the labor market as sort of his excuse. In fact, if you want to look at it this way, if you want to give him credit, you could say, look, we sort of stood our ground at the July meeting, where we didn't give in to the presidential pressure. But now that we saw this weak labor print, now we have the perfect excuse to begin an easing campaign.
Ahmed, the market is expecting that cut in September, betting on it.
Right.
Let's just say, sake of argument, you don't get that cut.
Yeah.
Does the market need a cut, Ahmed, to move higher? Because I've spoken to strategists on the show this week who tell me, no, they don't think it does. But what do you think?
Well, look, it depends why the cut is not happening, right? If the cut is not happening because we see, let's say, a further acceleration in rates, that would not be a good thing. But if we see it because we see a stabilization in the labor market, then it really wouldn't matter, because obviously the market would rather the market go up, not because the multiple is expanding, but because earnings growth could stay strong. However, I do have to tell you, the fact that we've seen this divergence between PPI and CPI is starting to signal to me that companies obviously have been absorbing some of the tariff increases, but eventually, because the input prices are going up, their margins are going to get squeezed. So that's going to get reflected on the earnings side here in the next couple of quarters.
Ahmed, always great to see you on the show. Thank you, sir.
Thank you.
Now time for some of today's trending tickers. We're watching shares of United Healthcare, Salesforce, and Globant. Let's start with United Health, which is seeing shares rise. It's after the Warren Buffett-owned Berkshire Hathaway reported a purchase of 5 million shares in the beleaguered insurance provider, worth about $1.6 billion. The insurer has faced a rough year, we know, with the stock price sinking almost 40% year to date. Other companies that Berkshire acquired stakes in, like steel manufacturer Nucor and home builders Lennar and D.R. Horton, also seeing their shares pop. With Salesforce seeing its stock rise, that's after activist investor Starboard Value, which invested in the company in 2022 and pushed for profit margin improvement, reported it's increased its stake by 50%. Shares are also jumping after D.A. Davidson analyst Gil Luria raised the company's rating from an underperform to a buy, writing that the challenges impacting Salesforce are already factored into that share price. Now let's take a look here at Globant as well. That stock is sinking after issuing guidance for the company's third quarter that was below expectations for revenue and earnings, as well as full-year guidance that disappointed investors. The technology services provider reporting a beat on earnings and revenue estimates for the second quarter, sharing the company's AI pipeline has expanded to an all-time high. Well, what is the path ahead for the Federal Reserve rate cuts? We're going to talk to an expert after the break. Stay tuned. You're watching Market Domination. President Trump has still not decided on a nominee to replace Fed Chair Powell upon the end of his term next year. One of the potential picks cited in a CNBC report, Mark Summerlin joined Yahoo Finance's Julie Hyman and Jennifer Schonberger to talk about the process of being a potential candidate and where the Trump administration is when it comes to making a decision.
My understanding is they created a list of 11 people. These will all be vetted and interviewed by the Treasury Secretary. And at some point, that list will be narrowed down to a smaller subset. And that subset will then go on for President Trump to pick. So that's about all that I know at this point in time. And so we're still weeks and months left, I think, before we get a final decision.
Back in 2018, there was some reporting that you had been nominated as a Federal Reserve governor, and that you said that you didn't want that job at that point. Can you tell, is that indeed the case? And do you want this job if indeed you do end up getting nominated?
Yeah, no, that was a little bit of a complicated story, but they had asked me to serve as a governor, which I said yes to. And I had my interview with Secretary Mnuchin, And the plan was then to go to meet with President Trump in the Oval Office. But before that happened, President Trump nominated two other people for those positions, Herman Cain and Stephen Moore. And I'm not sure what the process was for that. And then 6 months, they ended up not getting confirmed. And then 6 months later, they came back to me. And at that point, I sort of moved on to other things. And so it was just a different
Gotcha.
set of circumstances.
Fair enough. If you got this nomination, would you take it?
I think, Fed chair is mission critical to the world. And I think you
enough.
gotta, if you believe you're up to it, you gotta do it.
Jen, I want to bring you into this because I want to get to current Fed policy. Aside from the choice of who's going to be leading up the Fed, I want to get to current Fed policy and the outlook. Next up, as we've been talking about, we have the meeting in Jackson Hole, then the September meeting. We got a lot of data between now and then. So what are we watching most closely?
Most closely watching for that tug and pull between both sides of the Fed's dual mandate. This week, we got news on the inflation front. The producer price index and the consumer price index showed that services inflation heated up a bit in the month of July. The Fed has been closely watching for the impact of tariffs on inflation. So the fact that we saw the services side, which accounts for a larger swath of our economy, start to bubble up has caught their attention. Chicago Fed President Austin Goolsbee said earlier this week that if we were to see subsequent reports where services inflation was on the rise, that would cause concern. And on the other side of the dual mandate, we did have that weaker than expected jobs report for the month of July. And so that has caused some members of the Fed to look at that side of their dual mandate and look towards a cut for the September policy meeting. I will be closely watching Fed Chair Jay Powell's speech next Friday in Jackson Hole to see whether he lays the groundwork for a rate cut at the September policy meeting. And it may very well be the case that the next jobs report for the month of August, due out on September 5th, will be the determining factor.
Well, it seems like in order to be considered for next Fed chair, the base has to be that you think that the Fed should be cutting rates now. You happen to think that, Mark, is my understanding. What, in your view, what is the data that does support the case for cutting?
Right. I mean, so if we look at the first half of the year, the economy was growing a little bit over 1%. And, it's not surprising because we had some fiscal contraction coming from the tariffs, and a 4.33% Fed funds rate is just too high. And the market will always tell you what you should be doing or give you pretty good clues. And the inversion in the front end of the curve, meaning that the 2-year bond is sitting about 60 basis points below the Fed funds rate, tells us that we can probably cut by 50 basis points without making the long end go up. And when we got the data revised, we discovered that there was almost no job growth in May and June. And had we got those numbers in real time, the Fed probably would have cut in both June and July. And it's important to market to that data. And so up until that revision, we had strong jobs data, weak GDP. We didn't know which one was true. And then the jobs data got revised into that. On inflation, I support an inflation range of that. I think anywhere between 1% and 3% is on target, because we can't really measure inflation with any precision. And we can't really control it with any precision. And so I'm less worried about inflation really accelerating, especially when we have demand growth a little bit on the weaker side right now.
Investors continue to monitor and watch for signals from the Fed on future rate cuts. And right now, let's welcome in here Jose Torres, senior economist at Interactive Brokers, for his take. Jose, always great to see you. Let's start with the economic data we got today, Jose. I want your take here. So retail sales, I saw your colleagues, other economists, they call this decent, Jose, largely as expected is how they put it. We also got that separate report on consumer sentiment. Add it up for us, Jose. When you look at these reports, what does it just broadly tell you about the American consumer? How healthy, how resilient is that consumer, Jose?
Josh, great to see you. The consumer is healthy and, quite frankly, relentless. When you look at what's supporting American households right now, you have rising stock prices, you have subdued unemployment, contained inflationary pressures, and you have the uncertainty from tariffs behind us. We already know we're going to have tariffs. It's going to be an average of roughly 15% on imports, and consumers, not just Main Street, but almost Wall Street as well, are ready to put that behind us. In terms of the consumer sentiment data, that data has been a lot more bumpy. Hasn't really served as a useful leading indicator post-COVID. The number was bad. Inflation expectations ticked up higher for 1 year and 5 years. We don't want to see that. But the hard data, the retail sales data, was decent. The industrial production data was to the weaker side as well. But I think that the main point here, Josh, is that the consumer started off the second half in stride. And when you look at the Trump policy mix and the policies that are working their way through the economy now, you add a rate cut, 2 rate cuts, or 3 rate cuts by year end, and you have this consumer that's on solid footing. You're really looking into a re-accelerating economy into the second half of the year.
Having said that, Jose, I also want your take on CPI and PPI. Now, granted, it's 1 month, Jose, but that caused some jitters among some economists that I saw. And I just want your broader take on the inflation picture, Jose, and what you see now and ahead.
Josh, I have a very unique take. The CPI and the PPI, it really didn't show much tariff pressure. In fact, the cost forces came from services. And why did it come from services? I think it's because we're seeing the consumer really rebound here. There's no more uncertainty from the tariffs as much as an uptick in relative certainty. And when you saw the airlines, they have tremendous pricing power, and that was reflected in CPI with transportation services leading. In PPI, you saw that in traveler accommodation businesses leading. You also saw brokerage businesses in PPI doing really well, and that's due to investor enthusiasm and appreciating asset prices. So we really didn't see the uptick in goods price pressures. We actually saw it from services. But Josh, with the CPI here at 2.7%, the Fed upper end range of 450, a lot of restriction on the economy. Of course, there's many areas of the economy that are doing well, but there are a lot of areas that could benefit from a rate cut. When you look at the profile of hiring, has been non-cyclical. In the summer, we got those revisions that brought job growth almost close to zero. Last summer when we saw job growth go beneath 100,000, that drove a 50 basis point cut in September last year. I'm thinking we're setting up for a deja vu moment there. As far as the market, the real estate market is suffering from, it needs a rate cut. Manufacturing also needs a rate cut. So although the conditions overall are very positive, you have those certain areas that could benefit from a few rate cuts. In fact, our prediction market thinks that we're going to get 2 to 3 rate cuts by year end. Our investors are very bullish. They've been buying stocks, exposure to call options, as well as yes forecast contracts that benefit from a strong economy, GDP, retail sales, payrolls, things like that.
What do you say, Jose, on the topic of inflation to economists, including very smart economists who are on this show, who say it is too soon to pop that champagne, that tariff-driven inflation, it's on the way, it's coming? You say what to that?
No, Josh, no. If it's up to a lot of my colleagues, we would never open up the champagne, and that's a shame. That's a real shame. We want to open up the champagne soon. Let's give it a few more months. But when you look at goods, core goods, right? Most of the inflation picture in the economy, services, food, and energy. Core goods, Josh, only 20%. 15% on that 20%, it's not going to move the needle much. And that's why we got that much weaker than expected CPI print. I don't think that we're going to see a huge uptick. In fact, Josh, we're going to see a little bit of inflationary pressure. Similar to what we saw during Trump 1.0, inflation got up to 3%. Only to retreat back to the mid-twos. But that's really the re-accelerating economy. We have these buoyant markets. We have strong investment. We're seeing consumer spending. First half, Josh, consumer spending was weak. But now we're seeing consumer spending rebound. Trade uncertainty behind this is a big reason why. And I think that we're not going to see significant inflation. Inflation is going to be contained. Final point, Josh, the supply side factors. We think a lot about in the economy and demand side. But when we look at the supply side dynamics, artificial intelligence, productivity gains, manufacturing onshoring, those are also going to be able to counter inflationary pressures and, offer you an environment where you can still grow with prices being contained.
Jose, always great to have you on the show, my friend. Enjoy the weekend.
Great to see you, Josh. You too.
Up next on Market Domination, Yahoo Finance's latest investor playbook. It's after the break. We've seen a rush of economic data this week. Yahoo Finance senior reporter Alec now is looking at how to navigate the inflation landscape with our investor playbook.
Heading into this week, the focus was on core goods and the potential tariff impact on everything from apparel to furniture. But instead of a sharp jump in goods, we saw services inflation firm. That showed up in both the CPI and PPI reports earlier this week. The producer price index that surged to a 3-year high, signaling that businesses are absorbing much of the tariff burden. So the concern now is those higher costs could soon be passed on to consumers, making the services side of the economy more expensive, just as the full tariff impact on goods is still set to play out. Now, markets may be mostly shrugging this off, still trading at those record highs, but economists are warning that the tariff effects haven't fully landed. Raymond James chief economist Eugenio Elliman, he said in a note this week, quote, "The full impact of tariffs is expected to materialize in next month's data, potentially pushing good prices higher. This complicates the Fed's September decision." And complicate is the key word here, Julie, especially after this morning's stable retail sales report. So this is really the chatter on Wall Street right now. And here's a bit more of what economists told us this week.
More concerned about its impact on future CPI prints. I think it's telling you that the price effects are starting to work its way throughout the supply chain. Yeah, maybe the July CPI print wasn't that strong, but come August, September, we might start to see firmer prints, and that puts the Fed in a tough spot.
The good news here, as you say, is that tariff impulse into inflation wasn't as high as anticipated this month. The bad news, as you pointed out, is that services inflation was pretty soft in prior months, and it did give the impression to many that, hey, maybe we could ignore tariff inflation because services weakness will offset it. But now I think a lot of that's reversed.
These are broad-based inflationary pressures that we're seeing just now. I see more reason for rates to be rising in order to not let inflation get away from us. Inflation is the risk that's on our doorstep, much more so than the labor market. The Fed officials know that.
And we do know that markets are still pricing in with near 100% certainty that the Fed cuts interest rates in September. Of course, Jackson Hole next week is going to give us a lot of clues into the thinking of the Fed, with Federal Reserve Chair Jerome Powell set to speak. But even with that September rate cut priced in by markets, investors still think we are going to see an additional 1 to 2 rate cuts from there to really end 2025 with about 3 cuts in total. And then more rate cuts are expected in 2026. So we're seeing that play out a bit in the bond market. Long-term yields, like the 30-year yield, for example, is ticking higher today. But all of this a big question mark as we continue to wade through this data, with more prints and reports expected in the weeks and months ahead.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.